Hi, everybody. This is Jeff Barton for the Mortgage Minute. Thanks very much for listening, for tuning in, for looking at what we do. We try to give you some information that might help you with your mortgage or your refinance this year. Let's look at some of the rates today. 3.08 for the 30-year, 2.49 for the 15, 2.63 for FHA. The jumbo's at 3.13. That jumbo really sticks to that number, doesn't it? The 5-1 ARM is at 2.25. And the 10-year yield, which has dropped a little bit, is at 1.49. I guess the bonds have really been trading pretty heavily in the last couple of sessions. That's why we've seen the yields actually tick down. A number of items to determine rate for you to consider is what happens when the Fed stops buying treasuries and mortgage-backed securities. You want to watch that closely. The Fed meeting coming up next week will discuss some of that. They call it tapering from QE, quantitative easing. It's happened a bunch during the last 10 years. We got off the quantitative easing for a while, and then the pandemic hit, and then they went right back to buying mortgage-backed securities and treasuries. Treasuries being bought are $80 billion a month. Mortgage-backed securities about $40 billion a month. These numbers artificially keep the rates where they are, and obviously keep the bond prices where they are. Now, we've seen some of the bond prices affecting mortgages recently. We will see that continue, although there are other factors affecting rates. One of the things affecting rates, obviously, is what's going on in the pandemic as economies keep opening. What we're seeing in the labor market, and let's just quote a couple things here. Unemployment is at 5.8%, job openings at 9.3 million, about 8 million people, 8.5 million people unemployed. So as you can see, the number of jobs available really outstrips the number of people who are unemployed, and you're thinking, okay, that should match up and people should go back to work. There are a number of items that keep people from working. One of the main ones that everybody politicizes is the unemployment benefits. Some 25 states are ending those unemployment benefits from the federal government. That's an extra $300 a week. They're set to sunset anyway in September, so this is a preemptive move on those states to see if that'll get people back to work. There are other determinants to that I think are equally weighed, but not necessarily brought up all that often. One is childcare. If you have a job that you haven't gotten back, or that you are now working from home, childcare for you is a little bit more important than it is for somebody who doesn't have childcare, and that may impact the fact that you are or are not going back to work. One of the other things about not going back to work is fear of COVID. Let's face it, not everybody is vaccinated, and people still are very afraid. 20% of the people who have been vaccinated will continue to be afraid and continue to mask up, glove up, and really protect themselves as much as possible. So we have to be understanding of that, and we'll see where the unemployment goes. The quit rate, this is something that you may not have heard of. Quit rate is the number of people that quit their job each and every month just because they just don't want to work anymore. Mostly that is because of the boomers who are retiring. There is a huge pool of skilled laborers in their 60s who are retiring, either because of COVID or because it's just that time of life. And as a result, there are, those unemployment openings. 4 million people last month quit their job. That's a lot of people. Let's see. Reasons for not returning to work. We talked about it. The benefits you're receiving, the fear of COVID, and child care. The end of cycle for rates or the start of new lows. It's interesting. We see the mortgage rates going back down to the 3s or the high 2s for a 30-year fixed rate loan. It depends on you if you get that rate. Now, there are certain prohibitive things that weren't in place at the beginning of the pandemic. One of them is the half-point hit to refis. If you're refinancing your house, you're going to have to pay a half a point on the rate in order to do so. And that's going to significantly increase the rate with which you get for your refi based on the cost that you have to pay in order to do that. Another thing about the end of the cycle for the rates and the start of the new lows. Is it that, and why is it that? As we discussed earlier, the mortgage-backed securities and treasuries being purchased by the Fed artificially keep the rates low, and then the demand on those particular bonds, because they were paying a yield of around 1.6% just last week, from people around the world, not just in the U.S., but certainly banks flush with cash because There's a lot of cash out there, by the way. If you haven't noticed, or if you try to get a loan in a business, you probably can. The PPP loans are ending, by the way. So if you're looking to get a PPP loan, that's a Paycheck Protection Program loan, now's the time to get involved in it. I had a son myself who worked in that field for Wells Fargo, has been laid off because not enough people have been applying. That's not a pitch to get him his job back, but it is a taste of reality of what's happening in that market. I'm Jeff Barton, your voice in the mortgage industry. That's a lot of information out there, and we'll see you next time for the Mortgage Minute. Bye.